Right, it gives me great pleasure now to bring on board Rahul Rathi, founder and fund manager of PMS. Let's take our conversation forward. This is the first time I'm actually interacting with you on this forum. So nice to have you on ET now.
Thank you very much. It is an honor and pleasure both talking to you and to be on ET now. Thank you.
Thank you very much. So who's convinced finally the media Shah guy to come on TV?
Who's convinced me to come on TV? The reality is my daughter. The other things are not important, but she said, I haven't seen you in TV in a long time. So happy to be here. But the other fact is also from a perspective that right now there is a lot of uncertainty, and some of the people close to me and who believe in me wanted me to share my views on them.
So nice to have you on ET now again. And I would say that thank you to your daughter that she convinced you. That's what I can say. So this is the first time we're interacting with you. Walk us through your investment philosophy, because as a fund house, you've always followed what could be called as big concentration. Don't take large bets, take concentrated bets. And just for the benefit of our viewers, some of your old stocks which I've tracked over the years which you invested in has been Maruti, HDFC Bank, Bajaj Finance. Right. So let's take your thought process forward. How are markets looking? Where are you investing? Where are you picking your spots?
Correct. There are, let's look at the background and then I'll tell you how things have changed. Over the last 15 years, delivering returns, we've always believed that good companies with large volume growth meant that there was a certain value addition that could happen and asset appreciation that could happen to the portfolio. So we believed in businesses that had a certain volume growth, which was about 10%, and which did not borrow money. That means that they also had pricing power. And these companies, as you held on for long periods of time, you would create significant amount of appreciation. And we were in an environment where interest rates kept on coming down. Because of that, asset appreciation fell in two parts. Just because interest rates kept on coming down, valuations started going up, and these businesses continued to grow at healthy pace. So there was a certain return that was more than the cash flows that they generation. So there was a multiple expansion that happened. And the second part that also happened was the fact that operating cash flows continued to do well because of volume growth. Both created a very, very nice mix of asset appreciation. This was Purnartha 1.0 when we used to talk about it. And it was easy. It was almost similar to people who held Asian Paints for 20 years, held HDFC Bank for 20 years, and continued to do well because the opportunity cost of capital at that point, because of interest rates coming down, was almost 20-25%. So it was criminal not to concentrate because you're getting great businesses with an asset inflation, and that strategy worked very well for almost 15 years.
So that was the first phase. What about the 2.0 strategy or 3.0 strategy? Where are you investing right now? What is your view on the market and where are you picking the spots?
Correct. So the focus was, so here's the background on data, given the names that we mentioned earlier. If you look at the returns over the last, so here's the thought process for us, is that returns are going to be lumpy. If your large cap bets can deliver significant alpha, then you have a liquidity, and your opportunity cost of waiting for serious multi-baggers is very, very low because these stocks are delivering 25-30% returns. And then you have a chance to continue to bet on emerging businesses which can give you the next 20, 30 times of returns. Our strategy from volume growth, because interest rate environments have changed, we've added two more drivers to our strategy. The first driver being volume growth, the second driver being operating margin expansion, and the third driver is a valuation and our understanding of valuation. We picked up GAIL last year at 110. Margins were at 1% compared to historical margins of 13 to 15%. And we knew that margin contraction was temporary, valuations were lower, it was large cap, and we rode the benefit of that. We are riding the benefit of a similar thought process in Tech Mahindra. So really bottoms up strategy, and continuing to focus on, instead of one driver and the environment where interest rates came down, focus on three drivers, regardless of what the interest rate environment is, continue to deliver a certain amount of return.
Apart from GAIL, what else? You got me talking.
Apart from GAIL, we've got, Bajaj Finance and HDFC Bank have not done well for the last 3 years. But while Bajaj Finance has not done well, Bajaj Holdings has delivered a 33% CAGR over the last 3 years. Taking cues from that thing, what we realized was we bought Bharti, but we bought partly paid. So the alpha that you get because of the 400 rupee difference is much higher.
Why do you like financials? Because ultimately one looks at financials, they have a leverage balance sheet. And if I look at return on capital, which is an important matrix, the return on capital is, it is in 20s. It is not 30s or 40s with Asian Paints and Pidilite have. So with a leverage business, if you're getting this kind of return on capital, is it a good business to invest in?
Great question. So think about 2020. Okay, so the COVID time, tell me how many financial institutions went bust?
Yeah, please go ahead.
So I'm asking you how many FI. So you're saying that Indian borrowers are so good that we don't need to bother about risk. The reason why we picked up great franchisees were because their ability to collect and their knowledge about risk management. After 2020, the premium that a good business with very, very good risk management fundamentals, I don't see any value premium paid for such businesses. Essentially, it's just about growth, not about the risk side of things. And if I pick up a great business, I apply all my expertise in the team and find out that here is a business that understands risk, knows how to price risk, and will continue to deliver a certain risk-adjusted superior return. And I look at the premium that it should have compared to any other business that's just growing. I don't see a difference. So I don't know what value add will I have in identifying. In fact, probably my knowledge is a liability in the financial investments sector, because I will look at risk first.
No, I think that's a good way to invest, looking at risk first. Hi, Rahul. This is Anish also joining in the conversation. You're talking about growth companies, and one of the growth areas of late has been manufacturing, capital goods, industrials that have seen quite a bit of momentum, even electronics manufacturing, etc. Is that a theme that you would still recommend betting on, because that's set to be the next decadal theme?
Absolutely. So for us, while all these themes will play out, what we like as a theme and what we are playing out is energy. We think that India's energy basket capex has not been done. There are quite a lot of monopolies in the energy sector. and especially in renewable and other places, balance sheets are clean. There is a quick return on investment, and there is a huge pipeline of orders that there are. So, in terms of for us, while we like sectoral themes and we like some of them, what we also have a discipline of is seeing that they fit into the drivers that we want. So there is something of a bottom up approach which is much higher than the top down approach that we have. And the bottom up approach, all the boxes have to be tick marked.
How would you value defense, railways, or for that matter, shipyard companies? Everybody is of the view that these are multi-year trends. These are businesses which are backed by government. These are businesses where government spending is high. So for next 5-10 years, as they say in financial parlance, the highway is looking very big or the size of the pond is great.
Okay, let's go top down. So think about defense, okay? So let's say if you have to put capacity for defense, would you put capacity based on wartime efforts, or would you put capacity based on peacetime efforts?
I like to draw your attention to what Buffett says are consumer monopolies and mod businesses, and every business needs to have a moat around itself. Which are some of the companies or businesses which you think have a general moat around them or a unique advantage? I mean, this is one of the favorite questions for every investor. हम हिंदी में कहते हैं मोट ही ढूंढते रहते हैं वो.
I think any business that has a certain level of distribution, which is beyond a tipping point, has a moat. Because in India, distribution is an extremely expensive affair, and you have to throw in a lot of money to build distribution. If you have a distribution which has a certain history, legacy, and a certain amount of performance, that I think is a big moat, and you can see it in the numbers. Any challengers to certain distribution modes will continue to require large amounts of money. And if they are able to buy assets at a certain price, you'll see that moat in the 5 years. So we look at distribution as a large moat, but even more is a certain capex that's very, very important to building the moat. So we look at, let's say, if there is a certain ROCE and we see that reinvestment of that particular ROCE is 20% or 15%, it means that they're not reinvesting in continuing to have a moat or build that moat. So we look at reinvestment rates very, very carefully when we're evaluating moats.
Alluded to the fact that the box has to be ticked when it comes to bottom-up stories, and I'm wondering, where are you finding those stories in this kind of a market?
Actually, I'm fully invested. There are so many opportunities that are there. So think about India, right? India is growing at 6-7% GDP growth. And it's such a large market cap. There are pockets of underperformance for the last 3 years. And you start seeing that it ticks up the bottom up, it ticks up all the bottom up boxes. And then you start overlaying a certain environment to it, and you'll start seeing that, yeah, it makes sense to, look at these companies. There is a structural story and you're getting it at a good valuation. Gale was something like that. Tech Mahindra is something like that. We have another. So Suzlon we picked up at 20s, in the 20s, was exactly similar to this. So you look at the bottom up, it has to tick all the bottom up boxes, and then you start seeing whether there is a runway that you can play. Because we are a concentrated strategy, Anisha, it's easy for us to be able to cherry pick versus be aligned to an index.
Is it a coincidence that you keep on buying all Pune-based companies? Bajaj Finance, Suzlon.
Pune has some great entrepreneurs. The entrepreneurial capability here keeps you always searching for good things. But no, a lot of our returns have come also from non-Pune based companies. So while Gale is not a Pune based company, Suzlon is, Bajaj is, but the others haven't been. And Phenolics also is. We picked up Phenolics.
Exactly.
So,
3 companies out of a concentrated portfolio of 7-8 stocks are from Pune. So just a lovely coincidence, that's what I can say.
It's testimony to the fact that any good entrepreneur who wants to set up shop, Pune is a great place. First Cry also is from Pune. Supam is also from Pune.
Yes. Okay. So, see, when it comes to investing, you can control the price at which you buy, the time horizon, you can control the quantity, but nobody can control the return. What we can preempt, or what any investor can preempt, is understand which way the earning cycle would move. Where, to your mind, for next 3 to 5 years in either companies or themes, you think that a 20% CAGR earnings growth could come? And let's look at some ideas. Forget what happens to stock price. That's a function of technical flows, macro. But where do you think there is a reasonable probability of a 20% CAGR earning for 3 to 5 years? Which are those companies?
So let's look at a 20 to 30% CAGR. It can come from 2 factors. One is the demand, but second is operational efficiency. And companies' operational efficiency does not require demand environment to be good. If you buy companies where you see that the operational efficiency is at its lowest, and you start seeing a direction of greater operational efficiencies, you will start seeing a certain amount of earnings CAGR that starts coming up. So the first factor is that you look at more than external demand. If you're looking at 20 to 30% and ticking the boxes, you see whether there are internal efficiencies that will drive up a certain operating margin expansion. Once you know that, there is a certain amount of confidence in why there will be an earnings CAGR. And after that, if demand gets overlaid, you have, a certain, multiplier effect that also comes in. So I really think that when I was looking at ticking all the boxes, given the interest rate environment today, I was looking at margin expansion as a driver along with earnings, along with volume growth, and at a reasonable valuation. I think most of the companies that we've picked up, we are seeing operating efficiencies which are internal in nature, driving up earnings CAGR, or a reasonable part of the earnings CAGR, not all of it.
Good having you on the show today. Thank you so much for making time and dropping by, and hope we see you more often on the show from here on.
It's a pleasure to be here. Thank you very much. Appreciate it.
Okay.
If you like this video, then like, share and subscribe to ET Now.